You might be asking yourself if there's some things that you should do before the year end to keep your finances on track. Spoiler alert, there are some things, but don't worry about it. I'm going to go through the checklist I use with clients today with you so that you can see the things that you should look at doing before the year's over. We're going to dive right in. We're going to start off with an easy one, required minimum distributions, RMDs. If you're over the age of 73, or if you've inherited an IRA account from someone and you're under the age of 73, you've got to take a distribution each year. So it's an easy one, but it's a costly one. If you don't do it, if you have a distribution to take and you don't take it, the IRS penalty is steep. It's 50%. It's a 50% penalty on the amount of the RMD, plus they make you take the RMD, plus they tax the whole ball of wax. So RMDs, don't miss them. You probably know about them. Make sure you take them. The second one, something that most people don't talk about, is tax gain harvesting. Yeah, I said tax gain harvesting. What does that mean? If you made money in your non-retirement accounts, you may have gains that have not yet been taxed. And depending upon where your income is, it might make sense to sell some of those assets before year end to realize the gain. Now, this is an important topic. Talk to your financial advisor, talk to your accountant about this before you willy-nilly start selling things. But there's a way that you can sell assets, create capital gains, and depending upon the type of capital gains and your amount of income, you may be able to realize those gains tax-free. A lot of times people miss that, and these gains compound year over year over year, and they get to retirement, they start looking at all of their money, and they have this huge taxable event because they've got all of these embedded gains, and they have to try to unwind it then. Take a little bit at a time, and if you do it right, you might even be able to do that without realizing taxes on the gains. Tax loss harvesting, that's what we're going to talk about next. That's like the ugly cousin of tax gain harvesting. Nobody wants to talk about it. It's less fun because in order to take advantage of it, you have to have some losers. You have to have some non-retirement money where you had a loss on it, and by selling that asset, you can realize the loss. Think when you were talking to your neighbor at the barbecue and he told you about some awesome stock and how it was going to go to the moon, and so you put some money into it and it didn't go to the moon. It did the opposite. It was a stinker. You lost from it and you're still holding it. It might make sense to sell it and realize that loss because you can use it to offset some other things. Again, talk to your accountant on this, but it can be beneficial if you've got some losers, depending on where your income is. You might be able to use that to offset some other thing. By the way, I forgot to say this in the beginning. If you're new here, my name is Antonio Cibella. I'm a financial advisor. I work with folks who are planning their retirement and do things like year-end financial planning checklists. I've got the channel here to help my clients as well as those that just find the channel and want to learn some more about their own retirement. I hope you enjoy the videos while you're here. If you like what we're putting out, subscribe to the channel. Come back and see us another time. On to the next one, Roth conversions. Come on, man. You didn't think I was going to do a video and not talk about Roth conversions if I could, did you? Depending upon where your income level is, we still have historically favorable tax rates right now, and you can take advantage of that by taking some of your to-be-taxed retirement money, paying the tax on it now, getting it into a Roth, because let's be honest, as far as things go financially, there's nothing better than having tax-free gains. You could do that if you can get the money over into a Roth. Check out Roth conversions, see if you're at a point where that would make sense, and convert some of that money separate from conversions. How about contributions? How about retirement plan contributions? Did you max out your 401k or your 403b or whatever your work retirement plan is? Did you take advantage of the ability to contribute to a traditional IRA or a Roth IRA? Depending upon your income level, you might be able to put money in directly into a Roth. You only get to do that each year. Now, important to note, this is not actually a year-end thing. You've got until tax filing next year to make a contribution for this year, but while you're getting things in order, take a peek, see where you're at. If you've got the ability to make the contributions, go ahead and make the contributions. Just make sure you don't miss out on that opportunity. Take advantage of a contribution, whether it's to lower your taxes now or to get the money tax-free in the future. Traditional or Roth, doesn't matter. All money that you put away is good money. What's right for you, you're gonna have to figure that part out. Hey, while you're watching the video, if something I said sparks a little bit of interest or some additional questions for you, check out the links in the description. There's a way that you can go out to my calendar and actually book some time directly with me. I can't give specific advice on the channel, that's not allowed, but I can if we're talking one-on-one. So if you've got some questions, reach out and get in touch. Speaking of contributions, how about HSA contributions? This is another one that a lot of people miss. Do you have an HSA account? Now, to have an HSA account, you've got to be part of a high deductible health plan. Certain types of health insurance nowadays allow for an HSA. If they do, it's the greatest of all money that you can put away from a tax perspective, because you get a deduction when it goes in, it grows tax deferred, and you can use it on the back end for qualified purposes tax-free. So you do it right, it can be triple tax-free. No taxes anywhere to be found when it comes to the HSA account. Now, there's two things. Like I said, you got to be part of a high deductible plan to be HSA eligible, and there's contribution limits. Contribution limits in 2023, $3,850 if you are an individual, $7,750 if you're a family. That's the most that you can put in. Again, you can put those in up until tax filing time, but if you've got the ability to put them in now, don't miss out on that. Don't forget. Don't cause somebody problems by doing it last minute. Just go ahead and get the money into the HSA account. It's good money to get put away if you can. How about gifting? It's better to give than receive, right? I never believed that. I always thought it was pretty nice to receive too, although it's good to gift. Gifting is still a very good thing, and if you've got assets and you want to give some of them away. Now, I see this all the time with clients. They say, hey, we've got this money. We're never going to spend it all. Some of it's going to end up going to the kids or the grandkids, wherever it may go, and we'd like to see them enjoy the money. I can't tell you how many times I've heard people say, we'd like to see them enjoy the money, and that makes sense because yeah, you get some enjoyment out of that as well. That's where the giving is better than the receiving. Here's the thing, don't run afoul of the IRS if you're going to give money away. There's an annual gift exclusion. It's $17,000 right now. You can give something up to $17,000 in value to a child, a grandchild, what have you, without having to worry about any tax ramifications. That's beneficial because, again, there's limits on what you can do. You can't just willy-nilly decide one day to give them $300,000 and then think that everything's going to be fine. This is another one that is best planned with your CPA, but be aware that you can gift a certain amount, and if gifting is important to you, work with your folks to figure out who and how much and how long. Create a gifting strategy. Don't miss out on it because of the calendar year where you just miss a whole year of gifting if that's something that's important. Last bit of business on the gifting front. Important to note that this does not count for things like churches and charities. Whole separate rules there. I've got some videos about that as well. Qualified charitable distributions come to mind. They're also a good thing, but they didn't quite make the checklist because we're trying to keep the video relatively concise. I hope you enjoyed the video today. If you did, check out our playlist here about retirement planning. I'll put it up here somewhere. You can click it and we'll see you there.